Today, folks, we need to talk about Canadian real estate investment trust REITs for those investors looking to collect monthly distributions on the back of the absolute collapse, the crash that has happened in the mega cap REITs in Canada. But now we're seeing some peculiar data. We're starting to see fundamentals improve, especially on the back of interest rate cuts that make investors speculate that we could see outsized returns in the coming years. But there's also some highly peculiar data we're going to review. So if you're on a path to financial independence, if you damn well one day want to retire early, hit the subscribe. Join me on that journey because the Toronto Real Estate Board has released data that I find highly peculiar that really relates to specific sectors of REITs we're going to look at. And I want to start first and foremost with the industrial rates. Okay, so when you look at industrial square footage and what it's been costing, the price has plummeted by 24.1% compared to last quarter, which I just find super peculiar in what's causing this. We've also, and maybe it's just the mass building. If you drive down the 404, there's huge amounts of industrial buildings going up everywhere. And I wonder if that's what's plummeting the square footage price. If you look at retail, on the other hand, there's been a lot of demand, especially over the holidays. I mean, the malls were absolutely packed, and we've seen a 68% increase compared to just last quarter last year. I mean, what is happening here with like these, like, you know, basic industrial sectors? Like, what's happening? Office, look at office. You remember after the pandemic, no one's going back to the office, baby? Well, we're seeing a square footage increase by 25.5%. These are not small year-over-year numbers. These have dramatic impacts on the REITs that we're taking a look at. I mean, look at condominium rentals. This is also highly peculiar with total apartment rentals up 29.2%. Average one-bedroom apartments absolutely starting to plummet, not massively, but a 5-10% correction is pretty material for those that are looking for rentals. Yet total new listings are down 31%. Really weird, right? Like, I can't really wrap my head around exactly what's going on in the calamity that's been the Canadian real estate market. But let's talk about the top weighted REITs, and we'll go down to the lower caps after the calamity that has completely readjusted how you should view the landscape of the real estate market. The absolute best performing companies in Canadian real estate have been service companies. Two of them have taken the market cap weightings of Canadian apartment properties. These have absolutely ballooned in the last 5 years. And it's incredible to think that, who would have thought servicing, real estate is actually better to own than the actual physical real estate? Because here we have First Service Corp, which has actually outperformed the S&P 500 over 5 years, almost a $12 billion market cap company. And if we take a look, they are literally, I live in a condo and they're third-party companies that are servicing the amenities, even HOA, when you take a look at Homeowners Association, they manage all of this stuff to multifamily, mixed-use properties, and so much more in between. If we actually take a look at the revenues, they've been seeing some pretty decent growth over the 9 months, going from 3.2 billion to 3.8. Like, this company is growing excessively, and I'm very curious to how this has happened under everyone's nose, because I don't think too many people actually talk about the servicing of real estate over the physical real estate ownership itself. And it clearly has paid off to just want to work for the real estate rather than take on the risk of owning it. Look at Colliers International here. This stock also outpaced the S&P, almost right in par with it, but still 5 years up 83%, a staggering $9.7 billion market cap. And when you look at the breakdown of investment management, engineering, leasing, capital markets, outsourcing, they have all these different sectors that have been growing, some of which in the double digits or mid-high single digits, which is still astounding, right? Total revenues at 1.17 billion for the quarter, 3.3 over the 9 month, about 3.1 over that time last year, about 7% growth. Not nearly as much growth to justify, I think, the higher values on these companies today, but still, you have to recognize that these have largely surpassed the largest REIT that used to be Canadian Apartment Properties, that is now trading at about a $7.1 billion market cap. Analysts on Canadian apartment properties have recently become incredibly bullish. We've talked about this before, and it's really intriguing because the fundamentals have largely improved. And I'm shocked that nobody's really buying into this, because again, if you go back to that stock price, you're taking a look at a REIT that is paying the highest dividend that it's paid in virtually a decade. 5 years is down 18.42% and has basically been caught in this flatlining since 2018, which is quite astounding, right? On the back of operating revenues up 5% year over year, funds from operation are up 3.3%, very strong. The payout ratio is, in a very reasonable place. When I look at this company, there's nothing in here that screams that they're in danger, like they're having issues. They're seeing basically the residential properties rising in rental rates, even though we're starting to see a bit of a decline, but that's because most places in Canada have basically locked in government control over how much they can increase the rents. It's called rental control, usually 1 or 2% a year. So a lot of these people that are renting are getting a very favorable price apparently, because their average rent right now is what, about $1,515 to $1,650, which seems peculiarly low on the back of you can't even find an apartment in Ontario for under like $2,000 a month, right? But then you have Brookfield Office Properties, the next one in line. I don't really care for as much. It's very globalized office REIT with about a $6.9 billion market cap. But one of my favorites, hand down, my Riocan. A lot of people in our chat group have actually pretty much retired on the distributions that come from this REIT, and they have done a fabulous job adjusting this company over the back of the 2020 pandemic that just wrecked real estate that was primarily retail focused, which is Riocan. If we look at the analysis on this one, you're going to find that most analysts are highly bullish on these REITs right now. The market just does not care. They're all trading below the lowest analyst price targets, right? The average is like 21, and right now we're hovering around $18 a share. If we take a look at the sustainable growth here, first and foremost, EBITDA has been relatively strong. They're selling a lot of condominiums that are already 90% pre-sold. They're re-increasing the distributions after the cut they went through in the pandemic, which shocked a lot of income-oriented investors. But the yield right now sits today at about, I think 6% is what we're looking at. Yeah, about just right around 6%. So there's a lot of strong fundamentals going on here, I think, from my personal understanding and everything that I've looked at with this REIT. The total revenue sitting at $843 million, which is up 3.6% year over year. Everything seems to be improving. Funds from operations are relatively flatlining. And again, I think with the drop in interest rates, we should continue to see some relative improvement here. But the financials, if we just take a look at the quarterly from a year over year standpoint, they're definitely improving, right? From $271 million to $286 million. Cost of revenue, they've been doing a great job at keeping this relatively sustained and actually declining. There are a lot of good signs here, right? So that's kind of like where Riocan's sitting at, with a very strong, mix of clients that are highly diversified. The top being Canadian Tire at 4.4%, but you got Loblaws, Cineplex, not the biggest fan of, but hey, so be it. You got Metro, Walmart, Sobeys, Dollarama, Shopify. Their top name tenants, even the banks in here, these are all AAA, PetSmart, Rona, Liquor Control Board, the LCBOs, Bank of Montreal. Like, these are the strongest companies in Canada that Riocan is renting to, and there are no new properties that can really be bought up in Toronto or the surrounding GTA. As mentioned, all of these REITs have the largest property exposure in Toronto right now, and they are basically, turning these malls into condos, which is what we've seen Riocan, SmartCentres, and many of these other companies do. But Riocan is basically one of the top 5 largest REITs, next in line to Granite Real Estate Investment Trust. Now, this one, however, is more oriented toward industrial, as mentioned, which is in a really peculiar place. But this has been one of the strongest REITs over the last 5 years, up 5.87%, with a very strong 5% dividend yield, more or less flatlining though over the last 5 years. We're not seeing like huge substantial growth, but a lot more stable than the rest of the real estate sector. And that is on the back of this absolutely absurd growth, which I think has a lot to do with, basically e-commerce growth. There's been a lot of need for industrial warehousing, and we can see the revenues over the 9 month went from 391 million to 421, a dramatic increase, with funds from operation growing from 236 to 251. I don't think anyone's really complaining. Very strong payout ratio that's been improving over the last 9 months. So when I look at this REIT, I've always been a big fan. Very little dilution year over year as well. They've done a very fabulous job and are globally diversified, offering a little bit more stability than perhaps a Canadian-oriented focused REIT. However, they were highly fixated, and one of my biggest concerns was the exposure they had to Magna International, making up 27% of their annualized revenue. It used to make up over 30%, so it does look like they're diversifying with other clients like Amazon, which is really intriguing. So if you want to own the actual, if you want to be a landlord to Amazon, this is an incredible opportunity. But you look at their other tenants include Walmart, Decathlon, like Wayfair, some pretty major companies, even Samsung's in here. It's one of my favorite REITs in Canada. I don't personally own it, but I do like it a lot. The next biggest company, of course, is SmartCentres, yielding 7.57%, down 21%, very similar in line to what we saw with Riocan. And again, not as strong fundamentally. There's not as many analysts that are as bullish on this, but it's still well below its typical lowest analyst price target of $25, right? And I do want to see what the analysts think about Granite here as well. Let's see what analysts are talking about. Yeah, I mean, there's nothing but bulls on Granite real estate. There's no like negative sentiment here at all. Yet the stock is dramatically down below the 88 average price target analyst have put on it. This is what I'm telling you guys. Like, there's a lot of strong support going on for this sector, with the exception of a few companies. When we do look at the funds from operation here, we are still seeing improvements, right? So, I mean, even the funds from operations have increased. Everything looks pretty great. The company isn't diluting diluting. They're still diluting a bit year over year, but nothing substantial as they probably look to clean up their balance sheet as much as Riocan did. I don't like SmartCentres as much, but they're doing something very similar. They own a lot of outdoor real estate in Toronto. They're building a lot of condos, but they're going through this wild, vicious ride that the real estate market has been. Now, finally, let's just talk about two really honorable mentions here. The next lowest weighted market cap is actual retirement homes that over the last 5 years are still positive. They've been seeing a nice comeback with a healthy 3.89% yield. This sector has actually been relatively strong on the back of, I'm sure, them losing many clients through 2020. You know, the basically retirement residents got wiped out, and it was a very dramatic thing, you know, during the pandemic. But now they're starting to see quite a recovery. And when I look at the actual like revenues here, I'm quite impressed to see, you know, 545 million to 619 million. They're seeing a lot of growth as the demand for the older generation starts to come into play here. There's a whole generation of boomers that are probably going to be taking advantage of this at some point in the coming years, and this company is definitely seeing the benefit. If we take a look at the analysis here, I'm very curious to see that, yeah, also just like the industrial sector, nothing but high recommendations with companies that are trading fundamentally well below where their net asset values likely are. So super intriguing between, you know, industrial and residential, or sorry, retirement residential. Super peculiar. And the third honorable mention here, it's a very small market cap, but I've seen absolutely outsized returns with mortgage companies that are third-party lenders that don't relate to the bank lending system. MCAN Mortgage Group has had an incredible stabilized returns, you know, from 1990 with a wicked high dividend yield that has been very sustained with a 5-year 24.88% return, only being next in line to the returns we've seen from like First Capital. This would probably be one of the best performers up there with those kind of companies. And the only reason I can presume they're doing so well is a lot of companies couldn't get lending from traditional banks. So they went to these third-party lenders, and you can see that they're fairly diversified, mostly residential, and they also have insured residential mortgages that make up 44%, giving a little bit more stability to the entire portfolio if things did get a bit rocky. And I'm presuming because these people were already used to higher interest rates, they didn't see the same volatility, but whereas people couldn't get approved from banks potentially, they were getting approved from these third-party lenders at higher rates. And people stomach it, and they're paying it, and we're even seeing an increase. When you look at the, what I want to show you is there's data here. Before we look at the revenue, I really want you to look at the impaired mortgage ratio with credit quality. This is actually starting to improve, because one of my big concerns was quarter over quarter, we were seeing a massive increase in basically impaired loan ratios, but now they're actually starting to improve. They're at 1.19% for impaired mortgage totals versus 1.9 quarter ago, and they've been improving pretty much ever since, getting back to a more nominal place. And if you just take a look, I mean, the company's funds from operation and their payout, and not funds from operation per se because it's interest income, but if you take a look, like their payout ratios are very, very strong. You know, their dividends cash per share is 39 cents versus their basic earnings of 70 cents. So the company actually has a very favorable payout ratio, and they're seeing very, you know, stabilized increases of 22% in their mortgage interest income. I'm very, you know, perplexed by these companies and how they've been able to get through this market environment so damn well. But this is the state of the real estate market. This is kind of how I'm seeing it. I'd love to know what you think in that comment section below, and if you own REITs, what you think as well. But stay cool, stay awesome, folks. I look forward to catching you in the next one.